The multifamily fundamentals look really good right now. We've got two different reports, one from RealPage, one from Fannie Mae, both covering a little bit different time periods, but two different and unique takes about the apartment market. RealPage, a little more positive than Fannie Mae, not too surprising. We're also going to be talking about today a report from Marcus and Millichap on CRE, commercial real estate, a couple different asset classes within. And then if we have time, and I sure hope we do, we're going to be talking about gentrification, the Harvard Joint Center for Housing Studies, but a really interesting piece we're going to be going over with you, talking with Matt Bosnagel here, as we do every single week on the Gray Report. So if you're a multifamily investor, active, passive, somewhere between, you're in the industry, welcome. Thank you. We appreciate you spending the time with us today and every single week. We're breaking down all the latest research reports, data, articles, telling you what we think about it. Original opinions from Gray Capital, reporting live from the Gray Capital headquarters in Indianapolis, Indiana. Stick around, a lot of fun stuff. Let's get into it. Welcome back to the Gray Report, joined by Director of Communications and Marketing here at Gray Capital, Dr. Matt Bosnagel.
Hello.
Matt, great that you're here. I'm glad that I'm here. Thanks again.
For sure.
Love the report today.
I like it too. We were talking about, are we talking about the same stuff every week? No. I think
yes, no, maybe so. It's important, right?
I still get excited every week. I think that this week is particularly interesting because we're seeing some large organizations really start to figure out where we are in the apartment market, and we're seeing signs that it has made, I think, a major transition from last year. The sink down to the bottom. Now we are above water, and that is really going to chart a course for like the leasing season. And really, I think that we are in the beginning of a period that will characterize the apartment market in 2023.
And I think separate from some other asset classes and other areas of the economy. I mean, and it's really going to be kind of the life preserver or buoy that's going to get many multifamily owners, investors, and assets kind of through, this period of uncertainty and volatility. All this is overshadowed with, potential CRE, debt. I don't know if I want to say CRE debt crisis just yet, but, certainly major concern that we're going to be really facing us, directly eye to eye later in Q4 of this year. Man, we see a wave of maturities coming due in October of 24, going through Q1 of 25. Man, if performance wasn't looking good, I would be really concerned for a lot of owners out there. If you're at fixed debt right now, property's performing well, you don't have a lot to worry about. But if you are on a short-term, bridge loan, you got floating rate debt that's coming due soon, you're in the middle of a development project, whatever it may be, there's a lot of scenarios where you could have made some smart or questionable decisions and be in a bad spot. But fortunately, at least in many markets, performance is doing well. Vacancy's gone down, occupancy's up. We're seeing some positive rent growth and some signs of spring, which is great to see. Expenses are up though too, but man, you'd hate to see expenses up and rents way down as well. So,
and that's the kind of a little bit of a similar story with supply is this question of, vacancy. We're a little soft on the demand side compared to last year. Is the supply really going to hurt things and make it vulnerable?
It's one of those. Oh, and also,
but I think as a couple of sources will explain in this report, the supply may not be as dramatic as you think.
Not as much of a deluge, maybe like a solid downpour, but nothing like you need to it's not like a flash flood, washout warning.
And and the flash is interesting. This is going to be a wave no matter what, because the supply, the construction is expected to kind of abate in 24 and 25.
25 is a big fall off. Where I'd want to watch out for, Matt, if you were in, again, real estate's always hyper local. We talk about it every week, but nationally and just your average market, you probably don't have an oversupply issue to worry about that much. And any time that you have some duration, some time on your loan, you can really get through a lot. But it's for some of the hot markets. A lot of the CBDs that have seen weaker demand. And if you're developing something right now, or if you bought something on a bridge loan and call it downtown Austin, it kind of comes like top of mind. Because there's a ton of development going on in downtown Austin. It's pretty insane. That would be concerning from a supply standpoint and a demand standpoint. Now that being said, and this is why it's so hard, is that I'm not saying that Austin's not like an awesome place to invest, like over the long term. Like the demand's not going to like go away. Like there's a lot of people still want to move to Austin. They're going to that. Like that's going to keep happening. But just like there can be periods of like, oh, we built too much this year. And now in 25, we're not going to build anything.
Yeah.
So it's like if you can just get past those and that all get absorb and equalize, all can and may be good. But you could just be, playing musical chairs, music stops, and whoop, man, you don't have a spot to sit.
Yeah.
Which I think really is what's going to get on. So RealPage, Matt.
Yes.
We got an article from RealPage. U.S. apartment market rallies after 3 volatile years. I like the fact that we're seeing some rally, or at least described that way. Now, RealPage, they're typically a little bit more positive about the apartment market, but usually pretty transparent, I'd say.
Yeah.
What's your take? What are the conclusions?
Well, yeah, like what I said earlier, rent growth and demand went down in the past year, and it was just pretty clear. All of the metrics really cite June of last year is when things were really in the lowest slump. Now there's signs of stabilization in the first quarter of 2023. We've got net apartment demand is back in positive territory. Consumer confidence is moderately returning, and inflation is moderating, and mortgage interest rates are declining. Now that's good for home buyers, but in terms of just general consumer sentiment now, and we'll get to this in the following article, things are improving, and it's not maybe dramatically so, but it is the result of a months-long trend of improving sentiment, improving apartment demand, and an improving inflation situation such that I don't mean increasing inflation, I just mean that inflation is going to be, and probably is, less of a burden on renters than it used to be even a couple months ago.
It's interesting, the decline. Now June would be early for to see like a seasonal decline, but it is interesting. We've seen this decline, in a period, call it Q4 at least of 22. That typically there's between end of Q4, beginning of Q1, usually things are pretty slow. And so I don't know if there's any correlation or if there's any exacerbation of the declines and the slowdown, and also on the other side of that coin, I think, it's good that we're seeing some positivity, but, without the monetary policy that's going on, we probably would see more, but it's not, we're not making up from the last couple months, but at the same time, the negative last couple months was also a little bit of a correction, a resizing from the last year and a half. So I think we have to have some context. I mean, like, we don't, just looking at the size of these bars. I mean, the red ones, I don't like seeing red, but that's a lot of green. I'm really
glad that you mentioned that, because that was one thing I forgot in my notes is, yes, there are all these stories of why things should be going up, and the consumer sentiment, the inflation situation, the mortgage rates, whatever. But also there's just like pattern recognition. Every time things go up, things usually, if they go up dramatically, they're going to maybe go down to adjust, and they've already gone down. Maybe are we going to see a little bit of a bump up just from like pure mathematics?
I think a lot of it does come to, I think there's some, laws of, the universe that end up coming into play, and whether you want to get into, Fibonacci, retracement patterns, or whatever kind of cycle, whatever you want to talk about. But, what comes up must come down, and there's reversions to the mean, and that happens. It happens, especially in a really efficient market, which real estate is not. But humans are also a big market, and we're relatively efficient. We're making decisions all the time. And so we're talking about sentiment. It's, it's on track. Now, the difference here is obviously these are surveys, and, how do people respond? So there's a lot of different ways you can parse this data. But I'd say, Matt, I'm hoping it is more. Q1 still a cold quarter, and so I'm hoping it's not just the lack, seasonal depression, and it's not just things getting warmer that's making the sentiment a little bit better. I'm really hoping that people feel better, but that's in contrast to, I'd say, if you've been watching the media the last couple weeks, since some of the banking, Silicon Valley Bank, First Republic's going to absolutely get tore up. Might just completely fail. Again, like, I don't know, earlier today, I think before the markets open, it was down like 20%. Almost like trading a penny stock. And we don't have to go off on that tangent, but what I'm saying is, everyone's saying like a recession is just about inevitable. And we talked about last week of like, okay, well, maybe it's actually not, because if you're so certain, I'm like taking the counter trade to your absoluteness. But I'm just the sentiment, and maybe it's delayed because we've also said every 3 weeks it changes.
Yeah.
So like, do we need the next, the next sentiment survey? If it's negative, maybe we just know that the sentiment surveys, just are lagging and things are moving. It's so volatile. Things are moving just too quickly that these surveys are just they're less useful because they're not as high frequency as is required to make decisions about today versus you're talking about a month and a half. And there's going to be similar correlations talking about the just on the time delays and leading and lagging indicators. When are you looking at information? RealPage versus Fannie Mae.
Yeah.
The next report, Matt, Fannie Mae's from Q4 of 22 mostly.
Yeah.
RealPage is Q1 of 23. So it's obviously a different time period. It's going to look a little bit different. But typically, multifamily and real estate, going over quarter by quarter numbers was plenty of high frequency.
Yep.
We're just in a different time period.
I think that's kind of the subtext again. And for the past few weeks this is a time, strangely enough, where it probably does behoove you to follow the month by month, follow the quicker frequency.
It's month over month even. I mean, really, it's a day by day. I think is right now is unrealistic, but we really need a week by week.
Yeah,
and I know, Matt, you're putting in a couple of reports. I mean, and you some of the data you only had was quarter over quarter, and you're like, I at least need month by month.
Month by month.
This isn't going to work. So what else on this RealPage? What other conclusions? Or
this was a short report, but I would encourage people to go there and also click through on that RealPage report that has a link to their Q2 multifamily webinar. It's like a multifamily update, and if you click there, fill out the video. You can also download what they have is a 38-page, pretty decent report in and of itself. So maybe if you don't want to watch that video, you download that that PDF and you'll be set.
Matt, are you suggesting that people on the internet are going to want to read a report over watching the video?
I always read the report over watching a video.
But 100% of the time.
Maybe if anyone's like me.
Well, but that's why we do what we do. It's what you do. You're the one that reads the report.
Yes,
so you don't.
Everyone else, video.
I mean, read the report.
All the report.
Read the report, but you don't have. That's the whole point. Not everyone has time to go through every single report. I mean, you can select a few. But I mean, if you're listening to the Gray Report, you're getting the Gray Report newsletter, graycapitalllc.com/newsletter. You're kind of covered. Like you're going to be. I mean, you're up to speed. You're not going to miss a beat.
Yeah.
But then take the deeper dive. Like, no, I want to go one step further because I want to bring this to my team or whatever. I need to have this report. We've got it all for you, and take the deep dive, and then be like, hey guys, I have a question about it, and we'll get back to you. So, Matt, we were talking about it. So Fannie Mae, another report. This is from April 2023.
Yeah.
And just before we get into it, this is going over a lot of the same data, right? It's a lot of RealPage data.
Yeah. Fannie Mae often takes a colder, kind of less hopeful tone in their assessments.
And more conservative, I would say,
in general. And I think like you said before, it's kind of due to their role. They're the ones that are making the loans.
I mean, look at this report. I mean, it's again, quasi-government, state-sponsored organization first, let's go back to the RealPage thingamajig.
Yeah.
I mean, this is much prettier, and I mean, they've got a marketing department. I mean, Fannie Mae, it's good. It's good information, a lot more text heavy, and these graphs aren't as pretty, but certainly we can use them, and it's good stuff. So yeah, Matt, what's up?
So yeah, a little more, a little lower in terms of their expectations, but to their credit, they're getting data from RealPage. And to note too, we have said that RealPage is a little more optimistic, and maybe they are in their analysis, but in terms of their data, RealPage is squarely in the middle of the pack when compared to data from other organizations like Yardi Matrix, Zillow, Apartment List, and others. If you compare, they are almost at the average of everyone. If you
RealPage is?
Yeah.
I mean, I don't want to put you on the spot. I mean, it is one of your prefer. I mean, if you were going to take one, if you had to take one, I'm not going to make you pick, but if you had to take one, was RealPage so you see RealPage like that? I'm going to take it
for sure. RealPage is less, it is a little more stingy with their data in terms of publicly. RealPage, it doesn't hides it a little bit. They're not as forthright as say like Apartment List, where you can download everything.
They give the Fannie Mae and give it to us.
I know. Well, I'll ask him. I'll ask Igor. Igor Popov.
Yeah.
Now, as we the problem here, or at least what you might see here on the screen, is that they are taking their data up to Q4 when this transition, which is a reason why we say follow things right now, because things are in this transition. It has transitioned to be to improve. The apartment market is improving much more than this.
Clearly, Matt, we see a decline in rent growth Q4 22. But if we pop over to Real Page, and again, then this is for demand, not rent growth. But Q4 2022, I mean, we saw the same thing basically. Q4 22, big drop off in demand.
Yeah,
it makes sense. Now, what we don't see in the Fannie piece, is this kind of uptick in sentiment that we're seeing here from the Real Page piece, but they're not going through the first quarter; they're just ending at Q4.
Yeah.
So it makes sense. But what does that, I guess, translate to their outlook? Yeah.
So what they're really looking at is now that just kind of characterizes the baseline, their baseline take on the state of the apartment market, which is to show that we are far from the crazy, volatility or the crazy expansion that we saw during the pandemic. The bulk of this report is a comparison of urban markets and suburban markets.
Okay,
for multifamily, and their claim is that they're converging a little bit. I think that RealPage has actually noted that maybe suburban markets are doing a little bit better than the urban markets, which I think is still true.
Yeah.
But according to Fannie Mae, these are going to converge a little bit. The urban performance is going to get a little bit better, maybe as it catches up to the suburbs.
Where maybe they didn't put it on us because it would have confused. Where is that? Indianapolis suburban?
I know. I don't know where the suburbs are. I was looking
because there's a lot
really
of
comb through that,
because I was like Minneapolis, but I was like, it makes sense that is urban. You can see in general these urban markets are down here. Besides San Francisco, that just has been beat up.
Yeah.
Minneapolis has really been underperforming. It makes sense the suburbs are doing relatively well. But the Indianapolis suburbs, Matt, and again, I hate focusing on Indy, but I'm going to every time. And just because they're including the Indianapolis urban but not suburban, and I certainly know that the Indianapolis suburban was much higher than the Indianapolis urban, and higher than most of these markets, and year-over-year rent growth. And this is 2019 to 2022.
Yeah, so this is
different.
And I like this,
but I know we'd be beating
too, because man, this shows you the dramatic increase of rents in some of these places, especially if you cut it down to just the suburbs of some of these places. Wow. 40% plus in Tampa and West Palm Beach, Florida. That's incredible. And it's also worth noting, maybe the Sun Belt's not doing so great right now, but if you take in
2019 to 2022. Oh yeah, no, absolutely. It absolutely crushed it. I mean, Tampa, which has seen declines recently, is still doing really well. Austin, where's Austin on here, Matt? As we talked a lot about Austin. Austin isn't even on here.
Oh, it's on the top.
Oh, it's on the top.
Yeah.
So it's doing well, but it's kind of averaging out in the middle of the pack. But these Florida markets, Florida takes the urban and suburban, take, all the top spots. And then, to the Sun Belt's credit, the Sun Belt pretty makes up all of these up until Detroit, Michigan, urban, which again is fast. I don't think I missed anything. There's some mountain states. I'm throwing in mountain states into Sun Belt, like Las Vegas, whatever, Mountain West, whatever, California, not really Sun Belt, but it's sunny there.
Yeah, they're destination.
They're destination spots. But again, Matt, I'm confused because Indianapolis, I know, crushed some of these, even Sun Belt metros, and just put the tinfoil hat on. Just would it be going against the narrative?
Well, and I think these are select metros, and they've selected them.
Exactly. Select. Exactly.
Yeah.
Is that what they said?
Yeah, that's
select.
They're select.
Select. So it's not a ranking. They've
select metros that are ranked.
That means they've deselected.
Yeah,
they've deselected.
Cherry picked.
Well, I know because if they were like, well, Indianapolis, which is what, the 12th most populous city, it's not like a small city, it's state capital. Number one year-over-year rent growth market in the nation, to not include the suburban area, which was the highest rent growth that was right up there with all those Florida markets.
Yeah.
If you're going to include the Tampa suburbs, why not include the Indianapolis suburbs? And my guess is, I don't see a lot of Midwest suburbs on here at all, because I know the same cases in the Columbus suburbs, the Kansas City suburbs,
Not even Chicago.
the Columbus, Cincinnati, not even Chicago, which we know has had some good growth.
You just get Minneapolis.
Matt, and this hits on a little nerve, a pressure point, because I've talked about this a lot in this reports.
Mm-hmm.
Midwest gets ignored, and part of that I'm okay with, because we'll buy up all the deals.
Yeah,
it's good, but on another hand, it's decisions were made. Why not included? When I go to an NMHC conference, and we're going to talk about all the regions, and 30 minutes is spent on the Sun Belt, 20 minutes is spent on the coasts, and 5 minutes is spent on the Mountain West, and 30 seconds is spent on the Midwest. Yeah. And if you look at the year-over-year rent growth numbers, I don't think it's on the report, but they just released, I believe, RealPage year-over-year rent growth numbers. Mm-hmm. It's I believe Miami's number one. Mm-hmm. I believe, according to and just some other make the top spot. It's all Midwest after that. It's all Midwest. It's Indy, it's KC, it's Columbus, it's Louisville, it's Cincinnati. I think it's Chicago.
And I was watching that webinar that I was mentioning earlier, and it said, he's like, sure, there are these Sunbelt superstars that are still hanging in there, but these Midwestern markets, it's the stability. He's like, it may not, they may not be decent, but they are stable, which means I'd like to think that's good for investors. But
I think so. I think that you should. I mean, I think
you want predictability.
A little bit of premium for predictability. I think so. Not losing money is good. Yeah, I like not losing money. It's one of the big downsides of being in the Midwest right now. We're not going to see the dip in prices as much, Matt, because it's so freaking stable. Yeah. And Fannie Mae's over here saying like, well, and again, the migration, like I'm not debating the migration story on the Sun Belt. I'm not saying that Miami is an awesome place to live, and Austin and Phoenix, and those are going to be great markets. They are. I'm just saying there's no reason to say that people aren't moving to suburban Midwest markets just to ignore it, because it goes against the narrative of, the Sun Belt's the only place you want to be. Mm-hmm. And again, not saying it's not the Sun Belt's not a good investment thesis. You just don't have to ignore the rest of the country. Yeah. And, I've dealt with it, you've dealt with it, the whole life. And we're proud from the Midwest. I don't really, flyover state, wear it with a badge of pride. Again, it's one of the reasons why I have so many opportunities around here. Yeah. We have a lot of freedom and flexibility. And, I've lived in New York, and I've lived in Florida, and, my wife Alex, she went to school in New York, and then I moved out there, and I remember her telling me stories. She moved out to New York, and she's in this class with mostly kids from New York, not all, and they didn't know if she had internet. Like they thought people from Indiana had not yet gotten the internet yet. Yeah, and they were like, and they were certain that she was from a farm, and she's like, well, like my dad. Yeah, my dad was born on a farm and raised on a farm, but not everyone, and I wasn't. Yeah, and forgot the freaking internet. We know, and everybody's connected. You're not so special. I'm sick of it, Matt, and I'm sick of people from Fannie Mae and these other organizations who have a narrative. And it's a quasi-government government organization. Yeah. And to be pushing one narrative, one investment thesis over the other, when my tax dollars are somehow going to fund this, is absolutely BS. And I'm sick of it, and I don't want to deal with it anymore. Yeah. So we're going to have to get the data, and we have to call these people out. There's not a heartbeat over there, Matt. They don't know what they've been emptied out because they thought they're going to be privatized. So there's no leadership. They don't know what they're doing. Yeah. Get your reports right. Include suburban Indianapolis, let's do it.
Midwest exists. I'm surprised they didn't even put Chicago on here.
We're on notice, Fannie Mae. Yeah, Freddie Mac. Let's see your next report. NMHC out, Matt. Mm-hmm.
Let's do it.
Okay.
All right. We can move on to this Marcus Millichap. This Marcus Millichap take. It's a little bit again.
Let's put on the video because people like that, man.
Yeah.
It's funny. We've all seen probably the social media videos where it's like two videos, one on top of the other. Mm-hmm. It's apparently we got to have two things going on to keep our attention spans going.
Makes sense.
And we notice when we have videos, you guys keep watching, and it's good. It's going in the background. John Chang. It's always a pleasure to host in the middle of our whatever you call it, our videos.
Yep. So I know that we often feature videos again from our friend John Chang and Marcus and Millichap. This is well worth including as an update on the fundamentals of commercial real estate and how they vary from sector to sector. And he's talking about what's happening with CRE supply and demand, not necessarily the sales market that we've been talking about over the last couple of weeks, but really what each sector, how many renters are there, how many things are getting built. For office, it is a story of low supply, even lower demand. All of the ancillary
get out of office.
If you
didn't get out of office.
You read the Wall Street Journal, Bloomberg, Forbes, whatever. If they're talking about CRE and they're using the word threat or vulnerable or, systemic risk, they're talking about office real estate.
I'm so glad I was given some advice, years ago of just avoid office.
Yeah.
And I was like, offices need a place to stay too.
Yeah.
And, it's the easier to deal with, they're professional, and, they can wear a suit and tie to the lease negotiation and it's all nice and easy. And then it's like, we don't need offices. Yeah, that's the case, but like
even a little bit, can have a lot because it's multi-million-dollar industry, billions of dollars.
Yeah.
And it's changing, and that's the story. Low supply, even lower demand. Retail is relatively low supply, but demand has been remarkably steady.
Yeah.
And they're really on track to kind of improve in terms of
that makes sense. People still need stuff, services.
Yeah. They never really fell off as dramatically as maybe was expected during the pandemic, but it's definitely it's coming back, and there's
a good trend.
Some signs. So industrial, and I'm skipping ahead. I'm not dealing with apartment just yet because I've got more to say on that. Industrial, there's lots of supply coming online. Up to 2.3% of current inventory expected to be added this year. All that supply may not arrive because of continuing construction issues. The vacancy for industrial, maybe slightly softening demand that is expected to pick up in the next few years as retail picks up.
2.3%. Sorry, Matt. 2.3% of inventory being delivered, but 12% vacancy rate. 2.3% is not huge.
Yeah. That's it's going to be difficult to get to that 2.3, I think, because of the construction issues. And he elaborates on that when his discussion of the apartment market. Now, apartment.
Look at that boat.
I know. That's sweet. So apartment demand is lower and supply is higher. So apartments, on the face of it, you'd think, okay, lower demand is what they're saying, higher supply. This means trouble, particularly for investors. Now, that's not necessarily the case because, starting with supply, John Chang reports that, yes, a historic number of completions are expected this year, 2.1% of existing supply, 400 units, but they may not all be completed this year. He referenced conversations with developers, and basically they're saying, the quote is, their projects are behind schedule and their completion dates are slipping. Labor, commodities, materials, they're still not all resolved. And I think that we're seeing a ripple effect in just certain select commodities. It's going to be hard. And as for the demand side, however, currently, or maybe if you're thinking about Q4, sagging consumer sentiment caused by high inflation that really stalled household formation. But he does have a caveat. Now, I do appreciate the focus on household formation, and we have the graph up here of household formation and it really shows you a good idea of where apartment demand is headed. Because if you just look at inside apartment demand, you don't really get this sense of how apartment demand is a product of larger economic.
I'm glad you included this graph, Matt.
Yeah.
Of household estimates in just talking about how many households we're gonna need, because that's the bigger driver than anything.
Yeah.
That's what's gonna keep driving and pushing. Man, the pandemic was crazy. But again, back to physics and math, which I am not a math person. Like, I've got some really smart math people around me. Don't even go to my learning styles, but this is a period, that's a period, this was a cycle.
It went down, and now we are very much at the median. If you just kind of glance at this, household formations look pretty normal to me.
Yeah, it's amazing.
And they're heading up. Now, gently heading up, but still, household formation is not sinking, not near the bottom. It's at a pretty decent rate. And the same thing for consumer sentiment. Now, I will put a caveat on consumer sentiment because it seems like as time rolls on, people get sadder or people get less. The sentiment decreases because the average
existence,
I guess so because
higher
it does
lower highs, lower lows here, Matt, on the chart for general. And this is your take is obviously some correlation to like recessions but in general, people are just getting their perception of their sentiment is progressively trending that downwards.
Yeah, and I do not like surveys based on something that is as vague and amorphous as sentiment. I think sentiment's very much based on relative conditions. So like
there's a lot. Sorry.
Yeah. No. There's just I don't know if you were going to say this, but there's a lot of things that could make someone fill out that consumer sentiment form and act like they're sadder than they are. And a lot of it is just like, how were you yesterday? And it's not necessarily how you were relative to 2005.
No, I can I make a couple just observations based on this graph, Matt?
Mm-hmm.
Okay, and this is going to go back to our conversation last week on Gen Z teenagers and whatnot. They're all depressed and they think things aren't good. And this sentiment survey kind of lines up with that. Big difference I see in the change in the trend. Look at the 90s, Matt. I mean, that's a pretty distinct economic cycle.
Pretty nice.
But the 90s, I mean, the 90s were a positive place.
Yeah.
Post-Soviet collapse. United States, really the only superpower in the world. We're in charge. Democratic values. Seeming idea that politics somewhat work in this country. Although you go back in time, then people might disagree. Obviously, we had Timothy McVeigh and all that stuff. We had a bunch of stuff domestically, but relatively, people were positive. It was the 90s.
Yeah.
Star Trek Next Generation. That's what was going on in the 90s, Matt. We have this idealistic future going forward. What happened just after 2000 when this changed? 9/11, War on Terror, Patriot Act, completely changed the world.
Yeah.
We all know how it did. Things changed. There was a recession, obviously tech bubble burst and everything. And again, 9/11 played a big impact to that because people were just, the stock market not too good after 9/11. I'm thinking we're going to rally for America, but not really. Man, it's on a downward decline ever since. Now, obviously, the great financial crisis, things were very sad. Things were sad because everyone was like, we're going to have, you're never going to get a job, never going to make any money. And New York City is going to look like the streets of Jakarta in 4 years. That's what I was being told. Now things got better. Sentiment went up. That's nice. But again, lower lows. We never hit the highs of the 90s. The peak when everyone was happy, January 2000. January 2000. What was in January 2000? Well, I guess George W. Bush just, right? Yeah. He just took office. New president. Clinton, we had a balanced budget years before that. We got a new president. Things are good. And for whatever reason, new president, so we're hopeful again. 9/11 decision, just the world's changed. Got to go through TSA. We got to, you got to get patted down. They're going to grab you wherever they want to. Really bring on a little bit of a police state. Indefinite, all kinds. We changed a lot of things in the world back then. A lot of drone strikes, good, bad, good, bad, and the ugly. But man, people are not happy anymore. And this is why this is what Gen Z, this is the world that they lived, that they grew up in.
Yeah.
This period. And we got happier than this last cycle, even though it was like one of the longest bull cycles. Great period, low interest, free money, just shooting out free money everywhere. We got kind of happy. We got to the, the mid 90s happiness levels. We kind of plateaued. And then, pandemic, obviously, we were incredibly depressed. We had this period here, in the, sugar rush of free money here, post-pandemic, that we were like, oh, things are good. Money is absolutely free. And this was in, April of 2021, 2 years ago. Money is free. The flowers are blooming, and all rents are rising, wages are rising, and inflation isn't that bad just yet.
Not yet.
Inflation's bad.
Yeah.
Not too long. Well, really, a year after that point. Really talking about March of 2020. Wow, look at that low point. I'm sad. Things are good, and then people kind of realize down here in January of 22. Or June and July of summer, wow, these interest rates are really going up. They're not stopping now. it's increased. Why is it increased, Matt? Everyone says that we're going to go into a recession, or is it just volatile and all is good?
Well, okay. So I think
that was my whatever 5-minute take that you can edit out.
No.
If you want to, but is that
no? I think
good. Bad?
I think it's good. I think it's a decent analysis. I think you see the current situation right now. Yeah, exactly. It's measured happening is difficult, and I'm thinking these people are filling out these surveys wrong.
Yeah, then we forget to live is to suffer at some point. Yeah, we have to just detach ourselves.
This is my like kind of ultimate take here is I don't feel, now this is on my own experience and everyone has, everyone's sentiment's different, but I don't feel like things were as bad as they were during the recession in the past 3 years, economically particularly. Now, the numbers up for the consumer sentiment survey would say that our numbers from, January 2022 till now, we were at the same
happier.
Yes, we're getting happier, but we are at the same level of consumer sentiment as we were at the bottom of the recession. So that's where we were, and I don't think that's fair.
Crisis?
Yeah, the great financial crisis. I don't think that that's fair.
I think that's a really good point, Matt. It's a really good point. We are lower. Yeah, I wonder if there was any part of the great financial crisis that seemed pretty existential at the time.
Mm-hmm.
But is there more uncertainty revolving just more things? I mean, here's another factor that wasn't going on. And we had the war on terror, but, people were starting to stop pay attention at that point, 2006, 2007, 2009. Mm-hmm. I mean, obviously still going on, but war in Ukraine. I mean, there's a whole
I think that
War 3 that's kind of floating around.
Arguably, now everyone always says that there's more political acrimony in every year, but it seems like things are more politically contentious. With whatever the out party is, they're always going to say the economy is doing poorly, and then the in party will come in, and now they're doing better.
Do you think Tucker Carlson and Don Lemon were fired on the same day? Coincidence?
Oh no, that's on purpose. They're going to flip flop.
I think Don Lemon's going to go to Fox, and
right.
Tucker's going to go to CNN.
That's exactly what they're going to do. Yeah.
Oh, that'd be hilarious. I don't know. I don't really watch cable news, but interesting. I think they could do a show together. That would not work.
Crossfire.
It could. What real Tucker Carlson going to get? You don't know.
Yeah.
We should probably stay away because it's pretty. I think he's kind of a polarizing figure.
Yeah. Put that in the thumbnail.
All right, Matt. Harvard Joint Center for Housing Studies, they put out a lot of really good, more academic information, but real good practical sources. A lot of the figures you hear thrown around, how many housing units we need, over until 2035. That comes from them. They come have a very different perspective.
Yeah,
obviously,
for sure.
Not from a market based selling your real estate or whatever. More from kind of pretty 30,000 foot global perspective, maybe leaning towards a little bit, on kind of like housing rights side. But that's okay.
If they had a stance, it'd be against landlords. But
I don't think. But that's not. But I would say that is not their stance.
Yeah. They're very objective. They are, and they're just not like industry insiders. They're more they're academics. Is maybe the best way to characterize them. This article is maybe a more policy-focused article, but I think it does introduce an issue of neighborhood decline that I think is worth following. And I'm going to be interested in the potential policy results of this line of inquiry and the future research that comes out of the Harvard JCHS, which they're kind of calling for because they're talking about, this isn't just an example of some studies that are made. This is an example of a line of inquiry that they want to follow up. So looks at neighborhood decline and it distinguishes this process of neighborhood decline from the process of gentrification. And they say that kind of three ways that decline can enrich our understanding of housing is, if this idea of housing precarity, housing affordability, that's going to be different in a neighborhood that is declining versus a neighborhood that is, gentrified or just kind of remaining stable. Neighborhood trajectories are going to kind of affect us differently. Landlords can make different decisions in declining neighborhoods, and it's definitely, clearly different from gentrification. Promising areas for studying housing decline in like kind of their policy responses is, they ask to examine these policies and the practices of local governments as this, it's maybe not a nationwide issue, is the most promising kind of productive area to address this process is to look at it on a local level. Things like tax delinquencies, code enforcement, abandoned properties, these all can kind of be dealt with local government. And, maybe we can learn from mistakes. Maybe we can fit. It doesn't have to be a one size fits all, but it is it's not a foregone conclusion. There are ways and there are levers to pull to maybe improve these neighborhoods, and to understand residents' experience in declining neighborhoods, and to listen to the processes that are making things lower in value and higher in value. And one of my real takeaways for this, and a little bit of a subtext, is that both that decline in gentrification is a process. So, even for apartment investors, if you're investing in a neighborhood, that could be on its way up and on its way down. And it behooves these investors and anyone that is invested, whether it's emotionally or monetarily, to improve them. And so, and there are things that you can do that make it get worse. As a corollary, they talk about so the title of this is Social Lives in Neighborhood Decline. Now, as a corollary, homes are part of people's identities too. And even though an apartment renter may not be able to showcase this identity through a mowed lawn or like a siding or freshly painted siding, apartment owners can do a lot to encourage community, whether this is a social life or kind of the identity, to improve the lives and the monetary value of an apartment property.
The problem with this whole discussion is it's so subjective. Better for who? And because what is good for some is bad for others. And it's a hard conversation to have because you're coming in from totally different contexts. But, we're really talking about gentrification. Good, bad. It's so subjective. The question I would pose, and they kind of like state it right here, although they don't like really connect the two. What's the opposite of gentrification? Neighborhood in decline?
Yeah.
And so some people are, against gentrification. Does that make them pro neighborhood decline?
Yeah. And we've talked about that too. And I remember, talking about gentrification is really talking about change. And they don't want change. Gentrification comes with maybe improving property values, but then you get the property taxes.
Well, you get higher property taxes. You also displace people that, my family's been living in this neighborhood for generations and we can't afford the rent. There are a lot of unintended consequences. And I think that you can be, investors, homeowners, property owners, and partner with, local government or whoever is involved in the area can be smart about this. And like, hey, let's improve the neighborhood without losing the flavor and what makes this neighborhood great.
Yeah.
And it's easier said than done. And, it's never going to come out with like, we've kept everything, but we've just added, because there's typically fixed amount of space, fixed amount of like area. And, there's more demand, but then you can start improving things. But again, those the social aspects of a neighborhood. Yeah. Those are a lot of times those social aspects cost money. Sometimes they don't. Things that don't are like parks and, walkable sidewalks and, a safe area. But some of the things that certainly improve a neighborhood by providing jobs, by providing opportunities and services, businesses. People complain there's a fancy coffee shop now, it's gentrified. Well, they're providing, jobs and services, and you're creating different social opportunities in that community, a place to work. It's a restaurant. You bring more people in the area. They're spending money. But it's often a different type of person that has traditionally gone to that neighborhood. And I understand the sentiment of like, hey, this has been our neighborhood. Now you're just showing up. Yeah, I can't afford to eat at this place. You're coming in here.
Yes,
but the restaurant is employing 20 people from the neighborhood that's creating jobs in that neighborhood.
Yeah.
So I don't think it's like we have to choose, but at the same time, we are talking about progress. It's not always purely additive, and hopefully that the result is going to be greater than the sum and some of the things that were cast aside. But like, the falling down house, like, are we going to keep it just because like we like walking by it for the last 10 years? I'm going to miss it.
So I think that it is another. This was less emphasized, but it's kind of a pattern I notice is it seems like the things they don't like are when people come from outside, start changing the neighborhood.
Yeah.
The assumption is you're going to need a little bit of outside help if you want a neighborhood to pull itself out of decline.
At the same time, people complain like, we're never getting any investment. No one's investing in this neighborhood. We need this and that. And the classic thing is like a story. This is the classic, from neighborhoods that I've lived in, not necessarily right now, but like a couple of years ago. It's like a restaurant or something would open, like a bar or something.
Yep.
Or the example I'm thinking of is a brewery was opening up.
Yeah.
And everyone's like, well, we could use a grocery store. And it's like, true. Yes. I would love a grocery store nearby, but it doesn't mean the brewery shouldn't exist.
Yeah.
Because maybe the brewery then leads to the grocery store. And the brewery leads to something else. It's jobs. It's certainly not hurting anything.
Yeah.
And they're like, should the brewery's next to a park and we shouldn't be there. Well, there's a liquor store across from the park too. Well, the liquor store has been there for 30 years. I'm like, yeah,
people don't like change.
People don't like change. And I get it. And it's so emotional. It's your neighborhood. It's where you're from. It's where you live. It's where you're born. It's where your parents were born and your grandmother died and they can no longer afford to live there. It's hyper emotional. And what happens in a hyper emotional state is logic goes out the window. And that's why it's hard to have these conversations. So I appreciate Harvard Joint Center for Housing Studies to take a crack at it. I think they make some good points.
I think that, I do think that they make a good. If you read this, you will. It's a little bit sad, because they are talking about decline, and they don't really posit real objective solutions. That are specific. Again, this is more highlighting a line of inquiry.
Is the solution not gentrification in some of those areas? I mean, there's others like obviously like opening a brewery or coffee shop isn't going to be the solution.
That seems the clearest. The clearest one would be and people coming from outside discovering value in a neighborhood and investing money in it and creating that value. Now, I think what their unstated argument is to work with the people that live there and try and find a middle ground between people gentrifying and changing character too much. Maybe they have a stake in what is changed and what's preserved, but that's hard, especially if something is declining. Then, I wonder what they're talking about this process of decline, and then they're talking about how people come in and find value where there was nothing. How do you convince people? I don't know. There's a magic.
That is why entrepreneurs are paid for what we do. Is you find value and opportunity where others don't.
Yeah,
and that's why markets, capitalism can have very positive impacts on society. And it's and I'm not saying that the capitalism we have today, which isn't real capitalism, is like everything is perfect and all be all. But I am saying that it's not the government that's going to come in and fix these neighborhoods.
Yeah.
It's investors and it's people. It's the community,
and they're leaning a lot on
communities are always in a state of flux and change.
They're leaning a lot on local governments for solution. When what's even more local is the levers of capitalism.
Yeah, the local governments need to get out of the way. They can give any support that they can provide.
They're removed.
I'll tell you, because I started really getting into real estate or get really excited about real estate. As I was flipping houses in a, call it gentrifying neighborhood. Yeah, in 10 years prior, shootings and it was not a safe place to go. Now the neighborhood is a very safe place to go. It's a very diverse neighborhood, certainly wider than it used to be, and that is not necessarily a good thing at all. And there certainly were some people that were displaced in that neighborhood. But that is communities are in a constant state of flux.
Yep.
But to tell me that you'd rather go back 10 or 15 or 20 years now at this point and go back to, crime infested, just falling down houses. These are beautiful neighborhoods, historic neighborhoods that needed a serious investment. And I tell you what, the biggest opposition when I was trying to do that in those neighborhoods, it was the local government. It was the Historical Preservation Commission throwing up roadblocks every step that we went. And, so it wasn't the neighbors. The neighbors would come over and they loved what we were doing. So we were fixing up these old houses, and we were taking something that was being not used at all. It was this empty house. People on wherever side of the aisle, the left or wherever, they said, we've got these empty homes. We shouldn't have a homeless problem. We were trying to make the home livable. Yeah. And I could go on a whole litany of stories of the ridiculous stuff and the costs that we incurred on some of those projects because of local government. People really had no real authority granted. I mean, it was just so frustrating.
Greater good.
Yeah, who's good, and they believe who's greater good, whose opinion, what's the vision? Do we all vote on what the vision was? Yeah. Things seem to be pretty divided, and to have such absolute authority over the vision over your neighborhood, they believe they've been granted this authority, Matt, to bestow. That they're omnipotent and they know what the historic neighborhood needs in the future and in the past, and they will be the sole arbiter of paint colors and siding choices and things you can't even see.
Yep. That's good old HOA.
Yeah. HOA with a gun in their hand. Not really. But,
well.
Okay, guys.
The definition.
Be careful there.
Yeah.
Well, Matt, fun episode. A lot in store this week, next week. We've got reports. We've got some exciting researches coming out from Great Capital. Matt, can you take 30 seconds to give everyone just a little, just a tease? I know it's in progress.
Yeah.
I don't want to I don't want to be early, but what's the tease?
We've referenced this a lot before, and you've seen glimpses of it. We track a lot of the different rent trackers from all these different organizations. They all have different data and analysis, as you've kind of seen, and we're compiling them all, getting a report and including some information on loan maturities as well. So getting a view of not just one organization's view of how the rent and how the apartment market performance is going to be. Yeah. It is a very comprehensive view that we'll get some economic indicators, but we'll see what different perspectives we have, and you can come to your own conclusions. It'll be all laid out in a wonderful report we're coming up with next week or next month.
Q1 report as well, right? Yep. All good stuff. All right, guys, have a good one. See you next week on the Gray Report, and of course, go to Gray Capital LLC, graycapitalllc.com for more information. Put a /newsletter there if you want to sign up for the newsletter. If you're not subscribed to the Gray Capital YouTube channel, big mistake, and you do that right now. Give us a like and say that was unnecessary, but we'd love to hear it anyway. All right, thanks again. Thanks for watching. We really appreciate you taking the time. Catch you in the next one.